Next up, we have Standish Management, a long-standing Raise sponsor and an industry-leading fund administrator, to quickly share the top 10 mistakes made by back office managers. Please welcome Jeff and Bill of Standish Management.
Hello, everyone. Thanks for joining us today as we talk about the top 10 mistakes made by back office managers. I'm Jeff Givens, director with Standish's venture capital fund administration practice.
Hi, everyone. It's good to be with you. I'm Bill Hughlett, also director with Standish and one of Jeff's partners.
We've got 10 minutes to go through these, so we'll give you a high level on each, and please reach out to us if you have any questions. So without further ado, number one, not that these are in any particular order, Bill, but not taking cybersecurity seriously. How do you feel about this?
Yeah, Jeff, this is one of the most important areas for back office managers to get their arms around. Cybercrime has really begun to focus on the alternative asset space. There's just too much money for it to be ignored. Email hacking and spoofing around capital calls and distributions are something we see almost on a weekly basis. And ransomware, boy, you talk about the nightmare scenario for a fund manager. And the mistake that we see is not overcorrecting in this area. And we really mean overcorrecting and not having the right resources deployed. The solution we recommend to our clients is to outsource to a top-notch IT provider, preferably one that has industry experience. Just kind of a takeoff on the old adage, don't try this at home, leave it to a good professional.
Couldn't agree more. Next, dense quarterly reporting. Bill, how do you feel about this?
Yeah, I have some thoughts on this. I've lived it as a CFO as well as with many of my clients. And I believe in what I'll refer to as the inverse proportion rule of quarterly reporting. And that is to say that there is often an inverse relationship between the heft of a fund manager's quarterly reports and his or her performance. So our advice is to always start with the bare minimum reporting that's required by your partnership agreement. You can always add more if it's needed or if your LPs want it. But the effort that it takes to put a comprehensive quarterly report together, complete with MD&A, portfolio analysis, et cetera, is not trivial. And over a period of many years, you'll find that that time is much better spent finding deals, feeding deals, and exiting deals for your partners.
That's right. Yeah, no, I agree. Less can be more. Well, you're on a roll. Poor structuring. How do you feel about this?
Yeah, let me take this one too. The point of this slide really is that good structuring at the firm level and at each fund level is going to pay huge dividends over the years. And the mistake that we see many fund managers making is trying to oversimplify, do things on the cheap, and try to streamline the number and types of entities that they have under their control. So a good fund formation attorney is going to be able to guide toward the best structures for the type of fund investments that are being made. So our advice is don't cut short in this area. And, specifically, you should have a separate management company that sits over all of your fund families. You should have a general partner entity that sits over each fund family. And keep in mind that a fund family can be made up of several different types of entities to accommodate different types of investments or investors. Jeff, any thoughts?
Yeah, I think I would just add that you really want your tax, legal, and fund administrator all on the same page before you lock that in. Just make sure that everybody's in agreement.
Yeah, exactly. I'm getting tired of listening to myself, Jeff. So why don't you take this one?
Yeah, poor cash management and reserve planning. I think the mistake that I see is just a lack of communication and planning between the front office and the back office. Certainly on the short term, you just want to make sure that the front and back office is in constant communication and aware of what the cash balances are and the needs on a weekly basis. I'm also kind of surprised that there's some firms that are resistant to a line of credit. To me, it's an inexpensive tool for paying fund expenses and perhaps some small investments during the quarter. So extremely useful and really alleviates the burden of calling capital too often. And then on the long-term side of cash management, you really want to carefully plan and manage cash reserves for future portfolio activity. And Bill, I know as a CFO, this is probably an area that's given you some heartache. What's your approach to this?
Yeah, I don't have that much to add, Jeff. I would just say it's critical to build a fund forecasting model for each fund that's going to show how every dollar of committed capital plus what you're going to recycle is going to be deployed. It's a living, breathing document that sometimes needs to be updated on a weekly basis as things change. But trust me, there's nothing worse than waking up one morning, finding that your fund is nearly 100% called and you don't have the adequate cash reserves to support your critical portfolio companies or pay management fees.
That's right.
Jeff, why don't you do this one as well?
Yeah, so a lot to unpack. Selecting the wrong audit and tax firm, and then knowing when to use them. So breaking it up, I think first the mistake being that you don't want to commoditize these firms. They all have their pros and cons. And I think it's important to take the time to meet with several, with different partners where you can have different experiences and to make sure that you're a valued client. Also know that you can split the audit and tax work. If you're really happy with your auditors, but you feel like you need a little more firepower on the tax side, split the work. It's okay. And then knowing when to use them, treat your audit and tax firms like a partner. For example, if you have your first distribution of carry, get them to look at that calc real time. Don't wait till year end. The last thing, or the first thing you want to avoid is any conflicts of interest or differences of opinion rather at year end, and surface those real time. Anything to add, Bill?
Nope, I think you covered it.
All right, Bill.
I could take this one.
Yeah, all yours.
Yeah. So this is a super important area not to overlook. Ideally, before a fund closes or as it closes, the general partner should have a special policy in place. We call it a GPL, or general partner liability policy. It's finely tuned to the needs of the fund manager, and a good broker is going to be able to help you put this together. It covers all kinds of things like LP litigation, GP litigation. Cyber sometimes is included in this, employee practices, and a backstop to inadequate D&O insurance at the portfolio company level. Yeah, we just highly recommend that this be put in place. It's expensive, but it's well worth every dollar that you spend.
Absolutely. I'll take this one, Bill. No LP portal. The mistake, thinking that you're saving money by not having one. The reality is that portals solve 90% of LP requests. So your hard dollars saved are really being exceeded in time spent. And it's a secure way to transmit information like capital calls, which are very risky to send by email. All administrators offer software, so you can avoid the direct costs. At Standish, we use ARC, which again is a secure way to deliver capital calls, reports, K1s, capital account info, the list goes on. So really useful and relatively inexpensive tool.
Yeah. Jeff, why don't you take this one? It's near and dear to many fund managers' heart. It's also the biggest line item on their income statement.
That's right. The challenge is having support that includes redundancy and multiple levels of review without overspending. And, back offices tend to be fluid. Your star controller today can be another firm's star CFO tomorrow. So I think the reality is working with the fund administrator solves all of these problems, and the hiring, firing, training, laptops, cell phone costs, break room snacks, that all becomes the burden of the administrator, so that the GP can do what they do best and focus on investing. It's also, a third-party administrator is something that LPs have come to expect, and it's a fund expense. So no reason to burden yourself with those over-hiring or under-hiring issues.
Exactly.
Unprepared for fundraising. I'll take this one, Bill. So what I've seen is that there's a lot of last-minute scrambling, and we're seeing shorter cycles between fundraisers, and sometimes an underappreciation of the amount of information that's needed. So I think it's important to keep contacts fresh, maintain key portfolio data and performance calcs on an ongoing basis, and update decks and PPMs as a routine. Really to approach this as an evergreen cycle and stay a step ahead.
Yeah, I would just double underscore what Jeff said, that watchword is evergreen, constant.
All right, last slide here, Bill. No GP prenup. Go ahead.
I'll happy to take this. What we mean by a is how do you unwind a partnership that needs to be unwound? How do you resolve disputes between GPs in an orderly way? And how do you offboard partner or partners that need to be offboarded? A good fund formation attorney is going to help put these pieces in place. But the mistake we see is a resistance by GPs who are focused on the upside. They never think anything bad is going to happen within their partnership. But trust us, over the years, many things often don't work out. You can have diverging track records, the inability to raise funds, life events. It just, the list goes on. And some of these things will certainly happen in the course of a partnership. So having an orderly, clean way to unwind these things will pay off in the long run. Okay, I think we're done, but thank you for your time. Jeff and I will be doing a breakout session, and you have our contact information, so don't hesitate to reach out if you have any further questions or if we can clarify anything for you.
Thank you.